In this video, we're going to cover two main things. So firstly, we're going to describe Australia's investment and savings gap and what that actually means for Australia's economy as well as for foreign flows of funds into and out of Australia. And we're also going to cover the link between the capital and financial account and the current account. And these two pieces of information will help us understand where Australia sits when it comes to international transactions. On this slide, we can see that there's the identity which we can use to define the current account balance. So the CAB or current account balance is equal to national savings minus national investment. When we talk about savings, we're talking about the amount of money that the population decides to save rather than spend on either consumption or investment and so on. Uh, when we talk about national investment, here we're talking about business investment. So spending by firms to say buy machinery, to employ workers, to operate their businesses and so on. So here the I is not talking or referring to foreign investment here. So we're talking about business investment. So the story with Australia's investment savings gap is that the savings component of the current account balance identity is smaller than the investment component. So that means that uh, the savings here is less than investment. So what happens there is the current account balance becomes negative. So we'll say negative. And when the current account balance is negative, we define that as a current account deficit. So we know that Australia has been in current account deficit for some time now, and that is mainly because of two factors. So first of all, Australia's national savings is quite low because of its small population. And at the same time, investment has been particularly high because of the amount of money being spent by the mining sector to develop Australia's mining infrastructure and capabilities during the mining boom. So then you ask, so why is this relevant to the balance of payments? Well, the reason that it is relevant is because the way that Australia has afforded to maintain this high level of investment is through foreign investment. So, if a country does not have sufficient national savings to fund investment, what the country can do is it can attract foreign investment or foreign capital into the country in order to fund investment on, say, infrastructure, on mines, on roads, and on a range of different things. The table at the bottom of the slide lists out the relevant figures related to Australia's savings and investment. So on the table, you can see that Australia's national savings in recent times has been 23.1% of GDP, while national investment has been 27.8% of GDP. So here you see that investment is above savings, and what that leads to is a negative current account balance or current account deficit, and that stood at minus 4.7%. Okay, so now that we've covered the broad idea of the investment and savings gap, what I want to cover is what implications this gap has on Australia's current account and on Australia's capital and financial account. So here we have a diagram of Australia or the Australian economy and of the what you call the rest of the world. And I've labeled the rest of the world on the right here as non-residents. So we've talked about the saving investment gap, and what I wanted to demonstrate is what this all means for the balance of payments. So if we are to draw a line indicating how foreign investment flows into Australia, we can do that with a simple arrow. So we can call this foreign investment. We know that foreign investment flows both ways. So foreign investment can flow into Australia from other countries, or it can also flow outside of Australia to overseas. But we know that Australia, on in net terms, receives more foreign investment than it sends out to other countries, and that's why I've got the arrow pointing towards Australia in that direction. So, as I said before, there is a net inflow of foreign investment into Australia, and how that links to the capital and financial account is that a net inflow is represented by a surplus in the capital and financial account. So I'll write that down. So surplus in the capital and financial account. So this will be relevant in a second when we talk about the current account, but for now we'll just talk about the capital and financial account. And just so that we're super clear about what this surplus means, I will write surplus happens when so foreign investment into Australia is larger than foreign investment out of Australia. Okay, so we know that foreign investment can come in multiple forms. So it can be either debt or equity, but what is common for both is that there is a need for investors to receive a return from that foreign investment. So Australia will have to pay back funds or money somehow to non-residents. And what that's called in the balance of payments is income, and sort of income payment. That flows from Australia to the non-residents who have invested within or into Australia. And those income payments can be generally categorized into two categories, which link both to debt and equity. So they can be either interest payments that are paid for debt investments, or they can be share dividends that are linked to, as you would suspect, shares. Okay, so we've already mentioned that foreign investment is recorded in the capital and financial account. So then where do these income payments end up in? So they end up in the current account. So we can say that if we sum these together, this is recorded in the current account, and that would be under the income part of the current account. So when we step back and think about how we would record income payments out of Australia to non-residents in the double entry accounting framework, we know that an outflow of funds is recorded as a debit, and debits are negative. So what does that mean for the current account being in surplus or deficit? So we know that deficits are the negative side of the balance of payments, and we also know that if the capital account is positive or in surplus, the current account needs to be negative. So what we can write is that the current account is in deficit. Change the color. And the reason why it's in deficit is because income payments out of Australia is greater than income received by Australia. So when I say deficit here, I specifically am referring to the net income component of the current account. Okay, so that so that covers the income component of the current account. We often describe the income component of Australia's current account as the structural driver of Australia's current account deficit. So there's also the cyclical component of Australia's current account deficit. Of Australia's current account deficit, and that links to the trade balance, or the goods and services balance. So we know that trade can be a bit more volatile compared to income, in that in income, Australia has accumulated so much for an investment that there is a constant stream of income being paid out to non-residents. However, in Australia's case, its trade balance is much more volatile. So in the past, we've tended to import a lot more goods rather than export goods. More recently, however, we have started to benefit from the massive amount of mining investment into the mining sector, and we've started to export significant amounts of commodities, which has thus resulted in an increase in the trade balance. So if we wanted to just quickly describe this in an equation, so the trade balance would be export prices times export volumes minus import prices times import volumes. So in recent times, this component here has increased. So both prices, commodity prices, and volumes have increased, while imports have either, generally stayed quite stable. And that this change in the trade balance has pushed the trade balance or goods and services component into the positives in some months, and I think the most recent um, data point in the trade balance, which is August this year, has been positive. So the trade balance has been in surplus. But this contrasts with the current account income component, which has been in deficit for some time and which will continue to be in deficit for a long time as we pay off our foreign debt responsibilities, as well as pay back share dividends to those non-residents who have increased their ownership of Australian shares. Okay, so I hope that helps describe the savings and investment gap in enough detail, and that you have a better understanding of the links between the current account and the capital account, and why is it that the capital and financial account is surplus and the current account is in deficit. So in the next video, I'll speak a bit more about the capital and financial account in the context of foreign investment, and provide you a bit more detail with how we can understand changes in foreign investment.